Welcome to our comprehensive guide on real estate investing. In this video, we'll explore the key advantages and disadvantages of putting your money into property. Real estate has long been considered a solid investment, but like any financial decision, it comes with its own set of risks and rewards. Whether you're a first-time investor or looking to diversify your portfolio, understanding the pros and cons is essential. Let's start by defining what real estate investing actually means and why it's such a popular choice among investors worldwide. Real estate investing involves purchasing property, such as residential homes, commercial buildings, or land, with the goal of generating income or profit. Investors may buy properties to rent out, renovate, and sell, or simply hold on to as their value appreciates over time. This form of investing can offer both short-term gains and long-term wealth building. However, it also requires a significant amount of research, capital, and ongoing management. Let's break down the main types of real estate investments you might encounter. There are several ways to invest in real estate. Residential properties include single-family homes, apartments, and condos. Commercial real estate covers office buildings, retail spaces, and warehouses. Some investors focus on land, hoping it will increase in value or be developed in the future. Others invest through real estate investment trusts (REITs), which allow you to buy shares in a portfolio of properties. Each type comes with its own set of risks and rewards, so it's important to choose the right fit for your goals. One of the biggest advantages of real estate investing is that you're dealing with a tangible asset. Unlike stocks or bonds, property is something you can see, touch, and even improve. This physical presence often gives investors a sense of security, knowing their money is tied to something real. Additionally, tangible assets can be leveraged, renovated, or repurposed, offering flexibility that many other investments lack. Let's look at how this tangibility can benefit your investment strategy. Real estate has the potential to appreciate in value over time. This means that, as the market grows and demand increases, your property could become worth significantly more than what you paid for it. Appreciation is one of the primary ways investors build wealth through real estate. While market fluctuations do occur, historically, property values tend to rise in the long run. This potential for growth makes real estate an attractive option for those looking to build long-term wealth. Another major benefit of real estate investing is the opportunity to generate passive income. By renting out your property, you can earn regular monthly payments that help cover expenses and potentially provide profit. This steady cash flow can be especially appealing for those seeking financial stability or planning for retirement. Passive income from real estate can supplement your primary earnings and offer a cushion during economic downturns. Real estate investors often benefit from various tax advantages. These can include deductions for mortgage interest, property taxes, operating expenses, and even depreciation. In some cases, investors may also defer capital gains taxes through strategies like 1031 exchanges. These tax benefits can significantly boost your overall returns and make real estate investing more profitable compared to other asset classes. Leverage is a powerful tool in real estate investing. By using borrowed money such as a mortgage, you can purchase properties with less of your own capital. This allows you to control larger assets and potentially increase your returns. If property values rise, the gains on your investment can be magnified. However, it's important to use leverage wisely, as it also increases your risk if the market declines. Real estate is often considered a good hedge against inflation. As the cost of living rises, so do property values and rental income. This means your investment can maintain or even increase its value in real terms, protecting your purchasing power. Unlike some other assets that may lose value during inflationary periods, real estate tends to keep pace with or outpace inflation, making it a resilient choice for long-term investors. Adding real estate to your investment portfolio can provide valuable diversification. Because real estate often behaves differently from stocks and bonds, it can help reduce overall risk and volatility. Diversification means that if one asset class underperforms, your real estate holdings may help balance out losses. This can lead to a more stable and resilient investment strategy over time. Like many other investments, real estate gives you a high degree of control. You can choose the property, decide how to manage it, and make improvements to increase its value. This hands-on approach appeals to investors who want to be actively involved in their financial future. With the right knowledge and effort, you can directly influence your investment's performance. Investing in real estate can also have a positive impact on communities. By improving properties, providing quality housing, or supporting local businesses, investors can contribute to neighborhood development. This sense of purpose can be rewarding beyond financial returns, as you help create better living environments and stimulate local economies. Despite its many benefits, real estate investing comes with some significant drawbacks. One of the biggest barriers is the high entry cost. Purchasing property typically requires a large upfront investment, including a down payment, closing costs, and potential renovation expenses. This can make it difficult for new investors to get started, especially compared to other asset classes that require less capital. Real estate is not a liquid asset, meaning it can't be quickly converted into cash. Selling a property often takes weeks or even months, and there's no guarantee you'll find a buyer at your desired price. This lack of liquidity can be a major disadvantage if you need access to your funds in a hurry. It's important to consider your financial situation and long-term goals before committing to real estate investments. Owning real estate requires ongoing management and maintenance. From finding tenants to handling repairs and dealing with vacancies, property management can be time-consuming and stressful. Some investors choose to hire property managers, but this adds to your expenses and can eat into your profits. If you're not prepared for these responsibilities, real estate investing may not be the right fit. Real estate market is subject to fluctuations, just like any other investment. Economic downturns, changes in interest rates, and shifts in demand can all impact property values and rental income. While real estate is generally less volatile than stocks, it's not immune to market risks. Understanding local and national market trends is crucial for making informed investment decisions. Real estate investors must navigate a complex web of legal and regulatory requirements. Zoning laws, tenant rights, building codes, and tax regulations can all affect your investment. Failing to comply with these rules can result in fines, lawsuits, or even the loss of your property. It's essential to stay informed and work with professionals to ensure you're meeting all legal obligations. Owning property often comes with unexpected expenses. Repairs, maintenance, property taxes, and insurance costs can add up quickly. Even with careful planning, unforeseen issues like natural disasters or major repairs can strain your budget. It's important to set aside reserves and be prepared for these financial surprises when investing in real estate. Vacancy is a real risk for real estate investors. If you can't find tenants, your property won't generate income, but you'll still be responsible for mortgage payments, taxes, and maintenance. Extended vacancies can quickly turn a profitable investment into a financial burden. Effective marketing and property management are key to minimizing this risk. Real estate investments are sensitive to changes in interest rates. When rates rise, borrowing costs increase, which can reduce your profits and make it harder to finance new purchases. Higher interest rates can also cool the housing market, leading to slower appreciation or even declining property values. Monitoring interest rate trends is crucial for real estate investors. Real estate investments are often tied to specific locations, making them vulnerable to local economic conditions, natural disasters, or changes in neighborhood desirability. If the area where your property is located experiences a downturn, your investment could suffer. Diversifying across different markets can help reduce this risk, but it's not always feasible for individual investors. Investing in real estate isn't a passive endeavor. From researching properties to managing tenants and handling repairs, it requires a significant time commitment. Many investors underestimate the amount of work involved, leading to frustration or burnout. If you're looking for a truly hands-off investment, real estate may not be the best choice. Dealing with tenants, repairs, and market fluctuations can be emotionally stressful. Unexpected problems or difficult situations may arise, testing your patience and resilience. While some investors thrive on the challenges, others may find the stress overwhelming. It's important to assess your temperament and support system before diving into real estate investing. Real estate market can be highly competitive, especially in desirable locations. Competing with other buyers can drive up prices and make it harder to find good deals. In hot markets, bidding wars are common, and you may need to act quickly or pay more than you'd like. Understanding local market dynamics and being prepared to move fast are essential for success. For many investors, real estate represents a large portion of their portfolio, which can limit diversification. Unlike stocks or mutual funds, buying multiple properties requires substantial capital. This concentration increases your exposure to real estate market risks and can make your overall investment strategy less balanced. While real estate can appreciate, it can also depreciate due to market downturns, property damage, or neighborhood decline. Depreciation can erode your investment's value and reduce your returns. Regular maintenance and careful property selection can help mitigate this risk, but it's always a possibility to keep in mind. Unfortunately, the real estate industry is not immune to fraud and scams. Unscrupulous sellers, fake listings, and fraudulent transactions can all pose risks to investors. Conducting thorough due diligence, working with reputable professionals, and staying vigilant are crucial steps to protect yourself from potential losses. Environmental issues such as flooding, pollution, or hazardous materials can negatively impact property values and pose health risks. Investors must be aware of local environmental conditions and regulations before purchasing property. Environmental assessments and insurance can help manage these risks, but they add to the complexity and cost of investing. Real estate transactions can lack transparency, especially in markets with limited data or less regulation. This can make it difficult to accurately assess property values, market trends, or potential risks. Working with experienced agents and conducting thorough research are essential to making informed decisions. Demographic shifts, such as population aging or migration patterns, can affect real estate demand and values. Properties in areas with declining populations may struggle to attract buyers or tenants. Staying informed about demographic trends can help you make smarter investment choices and avoid areas with shrinking demand. Technology is rapidly changing the real estate industry. Online platforms, virtual tour, and digital transactions are making it easier for buyers and sellers to connect, but they also introduce new risks and competition. Staying up to date with technological trends is important for investors who want to remain competitive and avoid being left behind. Economic recessions can have a significant impact on real estate values and rental income. During downturns, property prices may fall, and tenants may struggle to pay rent. Investors need to be prepared for these cycles and have strategies in place to weather economic storms, such as maintaining cash reserves or diversifying income sources. Like stocks, which can be sold quickly, real estate offers limited exit strategies. Selling a property can take time, and you may need to accept a lower price to close a deal quickly. Alternative exit options such as renting or refinancing may not always be available or profitable. Planning your exit strategy in advance is crucial for successful investing. Obtaining adequate insurance for your property can be challenging, especially in areas prone to natural disasters or high crime rates. Insurance premiums can be expensive, and some risks may not be fully covered. Reviewing your insurance policies regularly and understanding your coverage is essential to protect your investment. Properties can lose value due to neglect, market changes, or external factors like new developments nearby. Depreciation can erode your returns and make it harder to sell at a profit. Regular maintenance and staying informed about local developments can help protect your investment from unnecessary depreciation. Using too much leverage can backfire if property values decline or rental income drops. Overleveraging increases your debt burden and can lead to financial distress or even foreclosure. It's important to balance leverage with your ability to manage debt and withstand market downturns. Some cities have rent control laws that limit how much you can charge tenants. While these regulations protect renters, they can also reduce your potential income and make it harder to cover expenses. Understanding local laws and factoring them into your investment analysis is essential for long-term success. Tenants can pose risks to your investment, from late payments to property damage or even legal disputes. Screening tenants carefully and having clear lease agreements can help minimize these risks, but they can't be eliminated entirely. Being prepared to handle tenant issues is a key part of successful property management. Maintenance is an ongoing responsibility for property owners. Regular upkeep, repairs, and upgrades are necessary to preserve property value and attract tenants. Neglecting maintenance can lead to bigger problems and higher costs down the line. Budgeting for maintenance and staying proactive are essential for long-term success. Property taxes can be a significant expense for real estate investors. Tax rates vary by location and can increase over time, impacting your cash flow and returns. It's important to research local tax rates and factor them into your investment calculations before purchasing property. Legal disputes can arise from tenant issues, contract disagreements, or property boundaries. These disputes can be costly, time-consuming, and stressful. Having clear contracts, good communication, and access to legal advice can help resolve issues quickly and protect your investment. In some areas, the real estate market can become saturated with too many properties for sale or rent. This oversupply can drive down prices and make it harder to find tenants. Researching local supply and demand trends is crucial to avoid investing in oversaturated markets. Real estate regulations can change over time, affecting everything from zoning to tax laws. Staying informed about regulatory changes and adapting your strategy accordingly is essential for long-term success. Ignoring new rules can lead to fines or lost opportunities. A lack of market knowledge can lead to poor investment decisions. Understanding local trends, property values, and economic factors is critical for success. New investors should take the time to learn about the market or work with experienced professionals to avoid costly mistakes. Summary: real estate investing offers a range of potential benefits, from passive income and appreciation to tax advantages and portfolio diversification. However, it also comes with significant risks and challenges, including high entry costs, ongoing management, and market volatility. The key to successful investing is understanding both sides of the equation and making informed decisions based on your goals, resources, and risk tolerance. By carefully weighing the pros and cons, you can determine if real estate is the right investment for you.